Yes, you read that title correctly. Trading a fair value gap made inside of one hourly candle can be the model which finally makes you profitable. You do not need a million concepts like breakers or order blocks. Focusing on what I call expansion theory and fair value gaps can easily pass you some funded accounts. I want this to be a longer video, so without wasting any of your time, let's dive straight into what I mean. Let's start by defining expansion theory, okay? What have I created here with expansion theory? Expansion theory to me is when we're moving from liquidity to a PD array, or from a PD array to liquidity, and because of that, we are expecting expansion, okay? So when we partner that with the power of an hourly candle at a specific time of day on a specific asset, you can really make some money here, okay? There's certain hourly candles which are prone to expand at certain times. This is because the algorithm is set on time zone, on a New York time zone, and certain hourly candles are just more prone to expand. So when we're anticipating expansion, this can be really useful. Let's dive into what I mean by this. So you may be asking, Loz, what are the times when we're due to expand? What are the times we're likely to expand? I'll tell you right now, on indices, the hourly candle is 10 to 11 a.m. This is the hourly candle that really can expand and that you want to look for a fair value gap inside of. On Forex, which we'll get into some examples of, it is the 9 to 10 a.m. candle. Okay, so it's an hour back from indices. But let's dive into this indices bit of price action here as an example. Firstly, we want to be expanding towards a target. So you can see here, if we head up to the daily chart, we've had an order block, got closed below, making it the order block, and then we created a swing high into this. I was expecting lower prices from here. So this candle, I was expecting to expand. Where can we target? Well, there's a nice discount fair value gap inside here, which would be a partial area. And then you also have some resting sell side liquidity down here. On the hourly time frame now, remember the times I gave you for indices 10 to 11 a.m. We dive into this candle here as we're meant to be expanding. Now we've already reached into the top end of this fair value gap, okay, when this hourly candle opens up. But we've still got a target of the midpoint and the bottom of the fair value gap, okay? Now, every candle must have an open, a high, a low, and a close. And this is especially the case with what I call these expansion candles. Now, expansion theory tells me that when we're expanding towards a target, we should have an open, a high, a low, and a close. And that's exactly the same thing on the hourly time frame. It's no different from the daily. So let's head down into the 5-minute and see if we can find a fair value gap inside here. You can see 10 a.m. opens up and we expand lower with quick momentum, and you can see we don't yet reach the bottom of the fair value gap, but we have strong displacement, and displacement creates what? Our familiar 3-candle pattern. You can see we have our fair value gap here. Extend that out in time and we hit it at 10:45 a.m. So we're still inside the hourly window, okay, from 10 to 11 a.m. Now, your fair value gap should be created within this window. It doesn't necessarily have to hit inside this window. It is better if it does, but it doesn't have to. If it came into here at 11:15, I would still take that trade because the fair value gap itself was created during this hour, okay? So this hourly candle had a run higher and it dropped. Big displacement, creating our 5-minute fair value gap. And if the 5-minute isn't clean, you can start dropping to the 3-minute, okay? And try finding a fair value gap within there. But we drop down to the 5-minute and there is a clear fair value gap here, which is easy to use. You would take a sell as soon as we tap that, because here's a little something for stop loss placement as well with this model. Because this fair value gap is quite elongated and it's stretched out, okay, you can either put your stop loss at the top of this first candle in the 3-candle formation, Or if you want to be even more aggressive, you can put your stop loss at the top of the fair value gap, okay? Targeting, remember we had a logical target in the bottom of that fair value gap on the daily chart, and you can see that gives us a clean 1 to 3. And let's say you risk 1%, you'd be 3% up on a funded account. Think about a 100k account. If you were 3% up on a 100k account, that's 3,000, okay? 3,000 for a lot of you is a lot of money. It's a lot of money to me. It's a lot of money to anyone, okay? So if you can find these specific setups at these specific times, you can really eat off of this, okay? This is a really simple model. Remember, the basis, we have to be expanding towards a target. So what's the logic? Let's recap the logic. We have a run up, and then this down close candle closed below this, giving our change in the state of delivery. So now the algorithm wants to deliver sell side. Every time we stab up into this up close candle, this should resist price from going higher and should support it to go lower. If we take our swing here, you can see that we actually have a discount and a premium. So when we're moving up into this order block, we're still in a premium of this price fractal. Remember, the algorithm or price, the algorithm moves price from premium to discount and discount to premium. When we're in a premium and we've had the logic of a change in the state of delivery, we're now expecting price to come into a discount. There's a discount fair value gap here, and there's a discount fair value gap here, okay? So that is the logic of how we came to the idea that expansion is going to happen. We then drop down into the hourly chart and look for these specific times for price to expand, okay? So remember the times I gave you, 10 a.m. candle and a 9 a.m. candle on Forex. Let's frame the logic for yesterday's sales, okay? 10 a.m. candle. Let's zoom into this 10 a.m. candle here. Now, we are in a discount of this fractal price swing, but there is a weekly or a monthly level. Yeah, this weekly fractal here is a market maker sell model, okay? So we are still anticipating expansion lower. We take our key time. Now, remember I told you every candle should have an open, a high, a low, close. This is no different when we're expanding. Let's see on the 5 minute if we can frame a sell off of this. Remember, this is the weekly sell side liquidity. Let's label that. Weekly sell side liquidity rests here, and we are trading up here once 10 a.m. opens up. Remember, we're looking for 10 a.m. to create a fair value gap. As price moves along, we consolidate a bit, but look, I want you to notice here. Remember I said open, high, low, close. 10 a.m. candle opens at this price here, 20,067. We then create the high up here at 20.1. We then drop down, creating displacement. All of this is our displacement. All of this is the open to high of the hourly candle. We go back onto the hourly chart, you can see open, high, low, close, open, high, low, close. When we're anticipating expansion, why can we also frame expansion here? Up close candle gets closed below, okay, after running buy side liquidity into a fair value gap in the previous day's lower half, okay? That's a whole separate video I need to cover. But in the previous day's lower half, when we're talking about expansion theory and anticipating this to happen, that's where high probability fair value gaps form. But for now, let's just use the logic of there's a fair value gap and we've ran buy side liquidity. We then get a change in the state of delivery as this candle closes below this up close candle. And you can see now we have an order block. So we've traded above buy side liquidity into a fair value gap, which has offered fair value for institutions and smart money who are selling short. We've offered fair value above buy side liquidity, had our change in the state of delivery, which confirms expansion theory is going to happen. And now look what we get. Expansion theory. Open, high, low, close. Open, high, low, close at 10 a.m. and the 11 a.m. candle also. Now, back to the framework inside of that 10 a.m. candle. 10 a.m. opens up. Let's mark up 11 a.m. And now remember I said we just need a fair value gap created inside this time window. This is our order block, if you remember. All of this is our order block. We change the state and delivery, run up. After 10 a.m. opens, which gives our open to high, drop down, which is our displacement we're looking for. And you can see here, we have a big fair value gap, which gets used to sell off towards the weekly sell side liquidity pool. Okay. This is why I say it's the only model you need. Look at how easy this was. Once you frame the logic behind the trade, you're just waiting for displacement and a fair value gap before entering, and then driving price towards the sell side liquidity. But the key is to know where the market is going. That's the key behind expansion theory. That's the key behind all of this. You must know where is price likely to draw to. And you can see here, after that, it is really simple. You would take a sell here. The fair value gap is quite big. So again, you can put your stop loss above this or even above this if you want to be a bit more safe. And target, you would stretch a 1 to 1.3. If you put your stop loss here, that's a nice 1 to 1.8 / 1 to 1.5. Okay. Not every trade needs to be a 7% or a 7 RR. It doesn't need to be that, especially with this model, because we framed logic. So the trade is higher probability. Once you know where the market is going, the trade becomes higher probability. So you don't need these huge risk to reward trades. This is enough. So with that being said, let's dive into some Forex pairs and let's look at expansion theory on Forex pairs, okay, and these time windows. If you take a look here at this, the first example my eyes went to. Now I haven't looked at this chart yet, but look at the biggest down close candle in this price move. When was it formed? 9 a.m. New York time. Expansion theory tells us these are key times that we need to be looking for price to expand if the framework and logic is behind it. So what is the framework and logic? Well, the dollar index had a change in the state of delivery to go higher. Obviously, euro versus the dollar means this should go lower in theory, and we are doing so. 8 a.m. candle opens up and trades above some buy side liquidity here. We then look for 9 a.m. to give us an open, a high, a low, and a close. What can we be aiming for? The bottom of this fair value gap. That's a really nice target. And you have this smaller fair value gap inside here. So let's again dive into this candle. Now that we've outlined some logic, let's dive into this candle and see if we can find a nice fair value gap to trade from. Okay. On the 5 minute, see if there's an obvious fair value gap inside of this candle. 9 to 10 a.m. for Forex. Now, I'm going to give you a few seconds to look at this. Right now, I don't see any fair value gap, so I wouldn't be trading on the 5 minute chart. I see immediate rebalances everywhere, but I don't see any fair value gap. Drop down to the 4 minute. Now, on the 4 minute, do you see a fair value gap? You see one here, but it's really high up in the range. Price is not likely to come down here, draw back up into this, and then sell off. So again, let's drop down once more. Then we're on the 3 minute. Now, do you see a fair value gap inside this? This is back and forth, immediate rebalancing, but then look what we get here. Since we've scrolled through all the lower time frames, you see a fair value gap created. Okay, this small fair value gap inside here is created. We've had displacement down, it gets created here, and look where price moves from. We get a huge drop down, aiming for what? This fair value gap on the hourly chart and the bottom of this. Okay, let's drop down into the 1 minute, see if we can even find more fair value gaps. Okay, now that we've framed the fact that the hourly candle should expand, you can really work off of any time frame here. I'm giving you the logic and the framework to go and backtest this, and you can even tweak this model to what fits your personality. If you like trading order blocks, then trading some up close candles when we're selling, this could be your model inside this 1 hourly candle. That's the power of this. That's the power of expansion. When we're anticipating expansion to happen, trading inside that candle that is expanding is really easy. On the 1 minute chart, you can see this candle opens up here. We get an open to high, really small Judas swing, but regardless, it is a Judas swing because all of this was a Judas swing. All of this price action was accumulating orders. We take out some intraday liquidity here, so we don't need to Judas swing much higher. We get one regardless, and you can see here to here, this is the hourly candle, okay? On the 1 minute chart, you can see how many trades you can actually frame here. So how would you frame a trade on the 1 minute chart? Now, I don't recommend you all go to the 1 minute chart and just start scalping, right? Like I said, the 5 minute chart is enough for you, or the 4 or the 3 minute. Really, you don't want to be going lower than that, especially if you're new and you haven't reached profitability yet. So anyway, for the sake of price action, how would you frame a trade inside here? Well, we get a big drop down and there's a fair value gap there. You may be looking for price to come into this, yet it never does, and that's fine. You would miss a sell here. But we create an up close candle before dropping down and closing below it with these two down close candles. So now, when price comes into this up close candle, it should support price to go lower. That's exactly what we do. Again, two up close candles that rebalance this inside here now get closed below. They should now support price to go lower. Every up close candle once closed below and we're bearish should support price to go lower. And you can see we continue to do so. Again, up close candle. This is our 3 minute fair value gap, if you recall. Up close candle, closed below, resist price, okay? And then drops lower and drops lower once again. So you could position yourselves from here down to here. That's a 1 to 3.5. Another up close candle. Let's say you missed this one and you entered here. Put your stop above this fair value gap just in case price does want to come back up into here. And there's another 1 to 1.6. So that there is like a 1 to 5. Okay. All through this hourly candle. All because we can anticipate this to expand. Okay. Because of the logic we outlined earlier. There's a dealing range here. When price sweeps this liquidity, we're in a premium of this fractal dealing range. We've got a discount fair value gap to aim for, and price does exactly that at the key time I gave you. Okay. So this is the power of expansion theory. When we have a clear outline of when we want to trade, expansion theory can be really good because we can dive into that one candle. So let's say we were anticipating a 4-hour candle to expand. You would get an open, a low, a high, and a close. Inside that 4-hour candle, you would do the same thing as we spoke about today. A 50-minute time frame would give you all the framework and logic, the same as this model does here. So let's dive into another example. If you take your eyes down here, right, you can see there's a bit of price action here that I want to dive into. You've got a wick, a big candle at 8 AM yesterday. This is your dealing range. Price made this wick, which took out sell side liquidity and took out buy side liquidity, naturally running above highs here, which gives us our dealing range. We then have a fair value gap inside this dealing range. You can see price expands overnight in London session, and then we create a mini dealing range inside here. If I move that back, you can see through this expansion leg, create a dealing range. Now, remember our key times for Forex, 9 to 10 AM candle. Here, that candle lies. What's the logic and what has the previous candle done before this? Well, the previous candle swept sell side liquidity into a fair value gap, then expanded higher with momentum, and it kept doing so. We then wicked down, I'm assuming with 8 AM news, into a discount fair value gap again. So we have taken sell stops, expanded up, come back into a discount fair value gap, and closed up here. The next candle, in theory, should expand. Again, we know what to do next. dive into the 5 minute, see if you can frame a fair value gap inside here. 9 to 10 a.m. and look at this, okay? Small, tiny fair value gap inside here. If that's not enough for you, let's try and drop into a 4 minute time frame, okay? Again, no clear fair value gap inside the 4 minute. There is this one, which actually does count. There and here, really small fair value gap, but it is there regardless, okay? And also this fair value gap. Now, why this fair value gap? You might be thinking this is really late inside the hourly candle because this is our hourly candle range. Yes, but remember the rules I gave you. If it is created inside the hourly candle, then we can take a trade outside of it. Look at this. When was this created? 9:52, 9:56, and then it closed at 10 a.m. This means that this fair value gap here was created inside the hourly candle, inside the hourly expansion candle, and you can see exactly what happens. Price afterwards wicks in and then moves higher towards a higher time frame target. You put your stop loss below this low because it rebalanced all of this inside here. This down close candle got tapped into, and then you could target a simple 1 to 3 and take away your money at that point. So because it was created, inside of this expansion candle, we can trade that outside of the hourly candle because it was created inside there. That's what we're looking for. That's the key here. As long as it is created inside the candle we're expecting to rally up, then we can trade that. Okay, let's go on to the dollar, see if we can find an example right now. If you look here, 9 a.m. does the exact same thing. The 9 a.m. candle is the biggest candle here. What's the logic? Well, we actually closed above this set of down close candles, and then at this point, and then wicked into it and expanded up. You can see at 8 a.m. now you'll see this often. At 8 a.m. once we've closed above the down close candles, 8 a.m. wicks in and rejects. The 9 a.m. candle, this is why it's so strong. The 9 a.m. candle then opened low, high, close after we've rejected from a PD array. On the 5 minute time frame, what's the logic here? Remember, we're looking for a fair value gap to be created. Do you see anything really clean on the 5 minute? That's your first thought. Yes, for one, if you take a look here, this fair value gap was created when? Inside of the 9 to 10 a.m. candle. We then tap into it after moving away, and that would be your entry because, again, we can actually take an entry as long as the fair value gap was created inside of here. Take a long from here, put your stop loss below here, and then target a 1 to 3. Really simple, and you can see price has kept expanding since then, and it ran all the way up here. All from framing this logic around the 1 hourly candle. If that's not enough for you for some reason, and you want to get in during the hour, let's again dive into our lower time frame, see if we can see anything. Not on the 4 minute, nothing is clean. Go to the 3 minute. Now the 3 minute does create a fair value gap inside here. Instantly I can see a fair value gap here, small one, and there's logic there. There's also an actual volume imbalance here. You go to this area, that is a volume imbalance. You can trade that. If there's not enough for you there, the 2 minute, any fair value gap created, again there's the actual gap, which is the key. If not, let's go to the 1 minute, and then you can see there's a fair value gap. Okay, this fair value gap, there's multiple fair value gaps here on the 1 minute. This there, another one here, and we can continue to take trades as we push up, creating fair value gaps because we've already had the Judas swing on the hourly candle. Now that is key. Okay, let's outline our opening price here. On the hourly 9 a.m. candle, price opened up at this point. This is our open, and here we have an open to low. Now we're anticipating buy side to be delivered, so our hourly candle should have an open, low, high close. It is important that that open to low is created. Okay, don't dismiss that. It is important that that happens because now sellers are induced. Oftentimes, this open to low takes out sell side liquidity. As you can see here, it does. So people's stop loss get hit from the open to low before we move up. Okay, so we've induced sellers and then we can finally move up, given our entry each time. Okay, let's dive into one more example. Let's say on indices. Now remember, I gave you the key times on indices. The key times are slightly different on indices. So let's look inside here if we can frame any expansion. You can see at this point, right? Remember, we're in a premium on the daily time frame, but price is consolidated, taken out sell side liquidity below this consolidation and moved higher with strength, rebalanced, and then we've gone into this day without dropping lower yet. Now our high time frame bias is to go lower, but there's resting buy side liquidity above here, and we're in an overall market maker sell model. For the sell model to be high probability, I would need some buy side liquidity to be taken out. Now that might be a bit of a tongue twister, but if you rewind the video, for a market maker sell model to be high probability, I need some buy side liquidity to be taken out. That's exactly what we can anticipate to happen here. Because we've got this large imbalance, okay, and you can split this imbalance into a premium and discount if you really wanted to. We want to be in a deep premium, okay? So when we're here, and let's frame the logic, we've got buy side liquidity above this. At 9 AM, we get a Judas swing lower. On the 5 minute, this will be obvious to you. We get a Judas swing lower at 9:30, clearly, taking out sell side liquidity. We sweep buy side, sweep sell side. Now both sides of the market are induced. We want to go back to buy side liquidity up here. And now we want to see if we can get expansion theory up into this. 10 AM to 11 AM because we're trading indices. And you can see here, there is a small fair value gap at the very top, which gets created during the key time. But for say that's a hard trade and a really small range. So let's dive into our lower time frames to see if we can get a better fair value gap to trade from. On the 4 minute, there are fair value gaps being left open here and then continue to be left open. So let's go to the 3 minute. Again, scroll through your time frames, 5 down to 1, and then start to frame logic on here until you see a clean fair value gap. If none of them show up, that's fine. You would miss the trade. It is as simple as that. Nothing on the 3 minute, so go to the 2 minute. And I suspect on the 1 minute, there may be some sort of rebalance, okay? You can see here again, I think this inside here looks like a fair value gap that got touched, but nothing clean and obvious other than this trade up here, this scalp on the 2 minute. Let's go to the 1 minute chart, okay? Now the 1 minute chart on indices can be a lot cleaner than Forex, okay? Just because of how price delivers. On indices, price action and these concepts are a lot more efficient, especially on the 1 minute. So you can scalp the 1 minute chart on indices because fair value gaps that you expect to hold usually do hold, and that's just how it plays out. So if you take a look here, straight away I can see a fair value gap which gets rebalanced before moving higher. And that's your model right there. Finally, when we create a fair value gap with some displacement inside our 10 to 11 AM window, which you can see quite clearly is bang in the middle of it, the buy side liquidity rests above here. There's your long, stop loss below this low if you really want to be safe. You can target just above the buy side liquidity, which would give you a 1 to 2. Again, the fair value gap's not too stretched out, so I really wouldn't put your stop loss anywhere above these 2 down close candles because they should technically hold. Again, that would give you about a 1 to 2.25. So if we move higher, let's continue. Fair value gap once again. Big displacement on this one. So your stop loss could go at the bottom of this. and then frame just above the buy side liquidity is another 1 to 2. A really short scalp, but it fits the rules, doesn't it? Okay, so you can hopefully you can see now how 1 hourly candle, when it is due to expand, and we know it's due to expand, how powerful this can be. Now, this is sort of continuing on from a theme on my channel where we talk about one candle and how that one candle, once we drop into a lower time frame, can give us so many trades and so many high probability trades, as long as that one candle, it could be a 4-hour candle, a daily candle, an hourly candle, as long as that one candle is due to expand. And hopefully you learned a bit more about how we frame an expansion here with this video. As long as that is due to expand, these are high probability setups, and you can pick out so many smaller scalps on the lower time frame. Let's say the daily chart, you could go on the hourly chart or the 30-minute chart and really find some nice fair value gaps on these, and it is the easiest trades you will ever find. Okay, that's why this model is so powerful. As long as we have an open, a low, a high, and a close, if we're obviously anticipating price to go higher, that is what you would expect. We open down here and then we close up here. That's what it looks like. But if we were bearish, it would look like this. We have an open here, run higher, drop lower, and then price closes over here. So this is literally what we're looking for all the time on every time frame. This is the key to the market, I think. I think this unlocks ICT concepts, basically, because when we're down here, we get an open, a low, usually below some old sell side liquidity, and then we expand. This is what expansion theory and what I've created is framed upon. Okay, as long as we're anticipating expansion and we're correct about that on a higher time frame, you can drop to a lower time frame and really frame some nice trades within this portion of the candle. Okay, think about this. Once we've had the Judas swing within the open to the high, these are scalps. Okay, these are scalps you can take. Now this could be a weekly candle, okay, and then the hourly candle, the hourly time frame, sorry, can be inside here, giving us the expansion. And it's the same logic here. If we open up here, our open to high, once we come back down here to here, made that a bit clearer, here to the bottom of this, this is you taking scalps. This is you taking small shorts at logical points, fair value gaps or order blocks. That is all you, and that is how you frame the best trades. So hopefully this model and this explanation did help you out. If it did, drop me a DM on Twitter or Telegram or even a comment here. And if you made it this far into the video, comment expansion theory to let me know you watched it and you want me to expand upon this more. So those of you who did make it this far, comment expansion theory. I know it's a long video, but I'm sure you appreciate my time and I appreciate you for watching. Those of you who did get to the end, I'm proud of you, and this is why I make this sort of content. So to let me know I should continue making longer videos and longer content, please do comment expansion theory. Drop a like if you enjoyed, and subscribe to me if you're new as always. Check out the links to my socials in the description below. I'm always active on Twitter, on Telegram, dropping gems on there and giving psychology advice as well. So with that being said, I thank you always for watching, and I'll catch you in the next video.